French banks have been a prime target for investor distrust because of their high exposure to Greek sovereign debt. A ratings downgrade by Moody's of giants Crédit Agricole and Société Générale only confirmed fears that a Greek default would send them into a tailspin. BNP Paribas was put on credit watch, one step away from a downgrade. Financial experts say they're hardly surprised.
What really worried us were all these crazy rumours we'd been hearing. Now the downgrade is there and it's limited. Moody's confirms that French banks are not in bad shape, and that's somewhat reassuring. It looks like there won't be any failing banks in the coming months, or even years.
French financial stocks have seen a dramatic downturn in recent weeks, wiping out up to a third of their value. For investors, that's a steep loss, and the banks themselves are now in danger of attracting unwelcome predators.
The fact that their share price is now extremely low means that French banks could become prey for possible takeover bids.
However, on Wednesday, banking stocks saw a modest rebound amid relief that the ratings downgrade was perhaps not as severe as it could have been. Although few went as far as France's central bank chief, who actually managed to portray the downgrade as good news.
None of this is very bad news, and Moody's is saying one very important thing that I have said myself these past few days. Moody's is saying that French banks' capital and profitability will allow them to absorb all potential losses on sovereign risk, and that is excellent.
Maybe so, but it's also clear now that the fate of the French banking sector is intimately tied to a solution to the Greek debt crisis. If Greece can be saved, so can French banking balance sheets. The alternative is a scenario that French banks are not quite ready to contemplate.